Hey everybody, this is Paul doing a video on Friday, the 13th actually. Market is currently open, as you can see, 12:07 Central Time here. And as you can see, market is pretty much flat right now. I believe the market's kind of waiting for more like earnings information from the different banks and the different companies that start reporting in January before it kind of decides what it's going to do. So where are we at, what's going on, where we been. So as you may have noticed, January has been pretty good if you're invested. So just for January alone, as you can see, I'm up 5%, give or take a little. Now I have been adding money into the portfolio. So if you follow me on Twitter, I make it pretty clear if I switch my thesis or anything changes on how I think about things. So what I've been doing is I've basically been fully investing for the moment, um, because I think I kind of get the general idea of how this is going to play out. Like, what's going to go on with the shallow, like a recession type situation, like where's a safe place to be, where's not a good place to be. So what I've been doing is I've basically been adding to different positions as I get money, because the market looks like it's kind of starting to price something a little different than what everybody's expecting. Um, so mostly I've been putting money into SPHD. As you can see, just different positions that I've added in here. This position has worked out very well. Um, Mostly maybe one or two shares of BST, some of AFB, and then maybe like of Lake or something like that. I bought one share of Verizon this week also. So as you can see, out of 256, I put 207 to work. Out of 442, I put 255. So there's the percents that I've been investing so far. And kind of like I guess we can kind of go over what's going on, like what in the world's going on. So the market really turned as soon as it got the jobs report. And the jobs report is prior to COVID or prior to like this inflation stuff, that jobs report used to be called a Goldilocks report. And the reason why it was called the Goldilocks report is because wage inflation was lower than normal. It had backed off from like 5%. The number was low, so it was a good jobs report. And those are the two things that you need. So it was basically jobs are going down, wages are kind of flat, and that's kind of what the market wants to see. Full employment, and the labor force participation rate ticked up like a tiny bit. So when the market saw that, that changes the narrative of what's going on here because the Federal Reserve has been saying they think that they need to get unemployment up to get inflation down. Well, you take that jobs report, plus you take the CPI report that came in, which was right about in here, and you kind of start to form a narrative as to like where we're kind of going here. So this is the bespoke chart. He updated it. Um, you know, Peak CPI was at 9.06. That was in June. Now, according to the bears and the people that are expecting a crash, what should happen is when the Fed raised rates, you hit peak CPI, jobs pretty much from here down to here should be gone. There should be a lot of unemployment in the system. And the problem is that there's not. So the bear narrative relies on unemployment going up, which would affect earnings. Which means, because if you see unemployment going up, typically people tend to pull back on spending. Well, that's not what's happening. Unemployment's going down and jobs are staying down. That completely kills the bear narrative. So, as you can kind of see, so here's the different areas. So right now, one of the things that was also included in that report was that housing number went up again. The OER, owner's equivalent rent, which is 30%. And I don't think there's a single person I don't even think the Federal Reserve believes that that number is going up anymore. So, as you can see, this is what you see. This is the reality of the situation. This is real time data. Fastest housing slowdown on record. But when you go over here, this might not show, but this like the core CPI is showing zero point 0.8 increases in inflation for housing. It's just reality is not matching right now. Houses are just sitting there. So what's going on is you have that jobs report, you have the inflation report. That gives the Federal Reserve the ability to say, no, we're not going to do 50 in February, or we might do 25. So 25 is pretty much going to happen. So that what that would mean is basically this number right here would go up to about 4.5, give or take a little. And then a lot of people on the Fed keep saying 5%, 5%, which is another 50 basis points. So 0.25. The thing is the bond market doesn't believe them. Like they just don't believe them. So that's why the market's rallying right now. So if you go down here and you look at the dollar has dramatically weakened. And then also the market has responded to the dollar weakening. And then also the market has responded to the bond market not believing the Federal Reserve. So what does that mean? Like where are we at right now? We're still kind of in a holding pattern. Um, we've definitely gone up a little. The market is kind of looks like it's going to trade flat here, and that's a good thing. That's kind of what you want to see actually. So after 2009, here's a good example. Right here, this was considered the bottom. So these are different bottoms in the market, as you can see, and when the recessions occurred. So here's the bottom of 2009, and if you were around in 2009, this didn't feel like a bottom. Obama had just been, elected president, but nothing in the market was screaming buy. There were some people that were able to realize that this was the bottom, given what they were seeing, and the reason why was because earnings came out and they had picked up from this dramatic drop right here. And I think there's this effect that people have lived through these big crashes, two of them so far, I know three of them if you've been around long enough, that that's what you think is the normal thing. Like these crashes are just the normal thing. Like, we're going to get this big crash. We're waiting for this big crash, and that's when we can call the bottom. Well, what's going on is we're not getting the big crash. We're not getting the thing that breaks. Like we don't have that Lehman moment. So what exactly is going on here? So what was supposed to happen here is you get this, and then you had a little bit of a run up right here going into November, and then maybe you might get another run up. But then this was supposed to be the bear market rally right here, and then what was supposed to happen is you went down, and then you were supposed to keep going down past, and this is the bear thesis. You're supposed to go lower. So it's kind of hard to show here, but you're supposed to go this direction. So the bear narrative is basically right now is in January we're supposed to be selling off down to here, and in February when we get the rate hikes we're down here, and then in March we're down here somewhere. But as you can see, we're starting to break above prior resistance levels, the 200-day moving average, that kind of thing. We're breaking above the 50-day moving average. We're getting kind of close to the 200-day moving average. If you can't tell why we're sitting here right now. So we're getting close to these different levels that are like, are we entering a new bull market? Some people have actually said that. This many days with this much volume and this much money being put to work, with China coming back online. So are we entering a new bull market? I'm not sure. Can't tell you. There's people that are much, much smarter than me that will make that determination. I am not that person. I wish I was. So what do I know? What do I know? I know houses are sitting there forever. I know the tech sector is currently in a complete and utter just disaster area, and it's going to take a long, long time to recover because a lot of those companies didn't even have profits to begin with. There were very few companies there that had actual profits. So what does that tell me? Buy things that have free cash flow, which are dividend stocks, which are the same dividend stocks I've been buying. You go to Starbucks, there's still a line around the block. That's a safe stock right there. I'd prefer to pull back to 100 and then I'd be happy to add more. Pfizer, is able to rely on other sources of income that don't involve the COVID vaccine, but there's still people that are doing the COVID vaccine, so Pfizer's safe. O, they don't rent out to risky clients. They do like Walmart, those types of things. So I've gotten rid of different things. So like a housing stock like KBH, like KB Homes, I think they're still, if right now it seems like the Fed is going to raise the 5% or at least 4.5% at some point and just hold. That's what we're expecting. That's what the market is expecting. Or, well, the market is kind of expecting them to cut right now, which is kind of interesting. So we're just going to get I think we're just going to get this sideways action, which is perfectly fine, which is exactly what you want to see when a market forms a bottom. That's how these things work. So what might end up happening is for this cycle, this right here, what you saw, because bears tried multiple times to push below this 35.85 and they pushed it a little lower. And in technical chart world, you hit a low, you retest that low, and then you go up from that low, and then you don't break below that low. So what was supposed to happen right around this area, just all in here, we were supposed to see unemployment just completely fall apart. So I think we're in the process of forming a bottom in the market. I don't know if we're in a new bear, in a new bull market, which some people have suggested. Do are we? There's still some people that still think we're back over here in the 2008 area, but there's some very, very smart people on Twitter who think we're kind of in this area, which is kind of interesting. Like, have we had the complete washout? Like, if you looked at the tech sector, we had the washout completely. Now we had 2001 and all that good stuff there that happened, but you can kind of see, is a crash in tech going to cause a recession for regular Main Street America? It will, if you're in San Francisco, if you're in that area, yeah. If you're in California, yeah, you're going to have budget deficits because your entire tech sector just exploded on you. But there's some people that are like, this 1980 situation, like, are we here right now? Are we in this area? Do we have something like this? Or are we here? This is when Reagan came in and cut all the taxes and stuff like that, and the market took off until it crashed again. But so that's kind of what the market's doing right now. Is just trying to figure out are we forming a bottom? If we're forming a bottom, that's actually a really good thing because that means we're not going to have the massive unemployment that people are expecting. And if we keep getting unemployment reports where wages are starting to trend down and just kind of go flat, and then it's still increasing, that's literally Goldilocks. That's what you want because inflation is coming down organically. All the Fed has to do is just don't screw it up. So this is a chart from the Fed right here, as you can kind of see. Basically, this is the Taylor rule. So the Taylor rule is if that's fancy talk for basically the Fed funds rate, the federal funds rate needs to be above wherever current inflation is. That's how you control inflation, and then you hold it there. So that's what the Federal Reserve is doing right now. They're still hooked on the Taylor rule. The Taylor rule can be kind of dangerous because it's kind of a very generic way of describing how to do or handle our economy. I don't like it, but there's a good chance next month we hit a five handle on CPI. There's a good chance the month after that. If you kind of look here, so this is where we're at right here. So if January comes in at another negative 0.1, we're here already from here. And this is where the federal funds rate is, 4.33%. So, and then if February comes in negative, there you go. And then this is where you really start to get to that interesting point. And this is why the bond market thinks the Fed isn't going to raise rates for the rest of the year. It's because we're going to know very soon. There is no ifs, ands, or buts. We're going to know very soon. So what some people are thinking is that the Fed is going to raise rates maybe in February, and then maybe in, I think they said May, and I think somebody said July. Well, if you look at this, you keep with this right here, we're at negative year over year CPI by here. So you're going to know by, I would say, March. So we're going to get the 25 right here, and then you're going to know by March. Somewhere in here, I mean, you're going to know by February, honestly, where we're headed. Like, if we get something like this, you're going to know by March dramatically. Like, somewhere in here, if we get anything in this little area right here, this little green area, the Fed pauses without a doubt by March. Because once they go under their inflation target and they're still going under and they're still going under, if you get something like this by the end of the year, the Fed funds rate is zero because they're trying to stimulate the economy. This is recession territory over here. This is where you don't want to be. This is the ideal scenario right here, kind of something like maybe it's crazy because you could even get in here, you could even go up on the CPI right now, and as the old things start to lag off. So that's kind of where we're at right now. Is But the Fed is kind of looking at this situation and they think that once we get down to 4%, it's going to be impossible to get back down to 2%. The Fed is living in la la land. Like, the Fed is blatantly just not looking at the information that's coming into them. If you look here, we've gone from 9 down to 6.45% with a real possibility of going back down to 5.4. If we get any of the readings, and it's going to happen because consumer spending in January is slow anyways because everybody spent all their money in December. So as long as even jobless claims are coming in lower, so certain states are going to get hit without a doubt. Any states that are very heavy into manufacturing, any states that are very heavy into tech are just going to get slammed. They're going to feel like they're in a recession. But right now, as it stands, we could be getting the soft landing scenario. Now that's a you got to really thread the needle on that one, and the Fed needs to learn. The Fed needs to come out and say, okay, we're definitely on our way to our target. We're going to pause right here. So if you get pause language after February, I think we hit soft landing. If you don't get pause language after February and they still talking about some crazy rate, that's a problem. So we won't know until after February where this is going to go. They could still very, very, very easily. We're already on a path to a hard recession if they don't cut or do something soon to recognize that the data is coming in. As you can kind of see, like Ford, for example, General Motors is getting hammered because Tesla already had to cut their prices. As you can kind of see right here. And the CPI report is very clearly showing like it's going to happen pretty soon. So the Federal Reserve just has to look at this data. I don't know if they're going to do layoffs. I don't know if they're going to do furloughs. I'm not sure how Ford or GM will handle that. But the car sector is in a complete wreck right now. It's completely wrecked. So that's why I'm saying if you're in like some state that relies on cars, that's where you're going to see it at. If you're in a state that relies on tech, that's where you're going to see it at. How fast does that translate into the rest of the economy? It depends on how fast or how hard the Fed is. If they hold it at 5% for the rest of the year, yeah, we easily get a hard recession. It's going to be the second half of the year because that that CPI number is reflecting of just a dramatic decrease and just like this very hard landing in cars, that kind of thing. So that's where we're at right now. So what am I going to do right now? I'm just going to keep adding to my positions that I know have free cash flow. So like SPHD, AT&T, Verizon, these types of things. These are basically things that people will use during a recession. Um, if I think we're going to have a soft landing, I'll add more into BST, BSTZ, that type of thing. Um, but as it stands right now, these are kind of where I'm at, and then we'll just kind of go from there. Okay? If you have any comments, just leave them below and just let me know what you think. Thank you so much.